Eric Jackson of EMJ Capital joins us once again. EJ, it's good to see you. I mean, the pain continues, and you're telling me that these are still buying opportunities?
Well, I'm gonna make the case, Scott. I heard Joe in the last segment say, I heard him say, hey, you don't want to be in these profitless tech stocks. I'll step aside. I was emailing with Josh Brown earlier today, Scott, and Josh, we were talking about ARK and a lot of these tech stocks, and Josh said, you know, there are going to be some investors that are going to stay away from these kinds of names for years. And I'm sure that's true. But I would argue that's exactly the time when you want to be looking selectively at these names. I mean, remember 20 years ago, there was a cover on Barron's that said Amazon.bomb. I mean, that was sort of the peak pessimism for Amazon, which was seen as a low-quality, profitless growth tech company at the time, and of course grew up to be a behemoth. So I would say that with ARK down 77%, I think, from its peak, you know, I would point to the fact that NASDAQ dropped 74% in the dot-com era. I think the Nikkei was off 79% from its 1989 highs. ARK's not an index, but there's a group of stocks out there that there's not much blood left to come out of that stone if you're pressing shorts against some of these names. And that's usually the time for buying.
Unless you think that the valuations are still just too high. I'm looking at names that we've spoken about most recently, Twilio, Zoom, you know, the likes of which you suggested to me maybe a month ago at this point that you had been buying. And they've gotten beaten up a lot since then, which seems to be the market saying what Eric says isn't necessarily going to be the case, that these multiples were so outrageously high that they need to come down much more than people like he thinks.
Well, you're right on Twilio, for sure. Twilio's down in the last few weeks since we spoke about it. I still think its valuation relative to the universe of SaaS stocks out there is really low, historically low for itself. And this is a free cash flow positive story. I would differ with, you know, on the Zoom front. Zoom's actually up 20% in the last month or so. It's up from its earnings. Everybody likes to say it's a pandemic stock, and certainly it's not a $580 stock anymore, and probably will never be again, or at least not for a while. But it's up nicely from $85, where it got a few weeks ago. It's trading at 5 times next year's sales, which in my mind is reasonable, and it produces a lot of cash. So I think in these names, there's 2 things that you should probably look for right now. The ones that are producing a lot of free cash at the moment, which someone like a Zoom is, but then there are names that aren't producing a lot of free cash yet, and I put Twilio into this category, but they could produce a lot of free cash down the road. And Amazon was in that boat 20 years ago. You have to think that if these growth rates continue with certain names and they're producing cash now, they could be mega free cash flow producers in the futures. I think those are the 2 kinds of names that you should be making your shopping list on these days and looking to take initial positions in.
You know, I could look at, you know, some of the numbers, whether it's performance, I could look at the earnings, I can look at what their price to sales number is, but maybe the most important numbers to look at here, Eric, is rates. And to see what the 10-year is doing and the 2-year and these rates shooting up, it is stunning to see. And maybe those are the most important numbers when it comes to these stocks. My question being, can these possibly work in an environment where rates go up even more from here?
Yeah, it's a good question. Historically, you know, there's not a perfect correlation between rates and how well some of these stocks do. And we spend a lot of time, you know, gnashing our teeth about it and concerned about it, and rightly so. But at some point, you know, the fundamental, you know, dynamics of a company, its revenue growth, is it producing free cash flow? Those can win out if they're priced attractively enough. So, we'll all pay attention tomorrow. And I would say, you know, don't pay attention to the first 90 minutes after the Fed's decision, because last time that happened, we found that was a poor predictor of how stocks traded in the coming 5 or 6 days after that. But regardless of what rates do and what the economic environment continues to do for the rest of the year, I would say these growth stocks, a lot of them have been re-rated so significantly that you should be looking to buy them now at these levels.
Got you. I appreciate the conversation, Eric, as always. I'll talk to you soon. We'll see what happens tomorrow. It's going to be interesting. That is for sure. That's Eric Jackson joining us today.